Imagine getting an extra $1,000 every month without working a single extra hour. No boss, no overtime, no trading your time for dollars. Just money showing up month after month, even while you sleep. It sounds like a dream, but for those who understand how to build passive income, it's a system, and one of the most reliable ways to do it is through dividends. Let's start with a reality check. Passive income doesn't mean free money. It doesn't mean lounging on a beach forever while cash magically falls from the sky. It means security. It means knowing that even if life throws you a curveball, like losing your job or facing an unexpected bill, you still have money coming in. And that security is worth more than most people realize. As legendary investor Warren Buffett says, if you don't find a way to make money while you sleep, you will work until you die. But here's the catch. Buffett himself still works, not because he has to, but because he wants to. That's the real freedom, having the option to work, not the obligation. And in a country where Social Security is under increasing strain, with more retirees, fewer workers, and rising national debt, relying solely on government benefits could be a dangerous bet. The future checks might not cover even the basics. So the question becomes, how do you build your own safety net? One that works quietly in the background, month after month, without depending on your boss, your clients, or the government. The answer: assets that pay you simply for owning them. And in the US, one of the most powerful versions of that is dividend-paying investments. These are stocks, REITs, real estate investment trusts, and other income-producing assets that share part of their profits with you, just for being a shareholder. Sounds simple, right? But here's where most people get it wrong. They imagine they can just buy a couple of stocks and instantly have $1,000 a month rolling in. The truth? It takes time, strategy, and a realistic plan. And if you want that $1,000 a month in today's money and keep it growing over time, you need to understand exactly how dividends work, how much you need to invest, and the traps to avoid. Because while dividends can be one of the most reliable income streams in finance, they can also be one of the most misunderstood. At its core, a dividend is just a slice of a company's profit paid out to shareholders. If you own a share of a company and that company makes money, they can choose to share part of that profit with you. It's their way of saying, thanks for owning a piece of our business. In the US, dividends can come from several sources. Blue chip stocks like Coca-Cola, Procter & Gamble, or Johnson & Johnson, which have paid steady dividends for decades. REITs, real estate investment trusts, which own income-producing real estate and, by law, must distribute at least 90% of their taxable income to shareholders. Business development companies, BDCs, utility companies, and even certain ETFs focused on income. But here's the first thing to understand: not all dividends are the same. Some companies pay quarterly, 4 times a year. Some REITs and funds pay monthly. Others may pay only once or twice a year. And just because a company can pay a dividend today doesn't mean it always will. If profits drop, if management changes direction, or if economic conditions get rough, dividends can be cut or even disappear entirely. That's why chasing the highest yield you can find is a rookie mistake. Picture this. A stock is trading at $50 and pays $5 in dividends over the year. That's a 10% yield, which sounds fantastic. But if the company's business model is crumbling and the stock drops to $25, that same $5 payout now looks like a 20% yield. On paper, it's amazing. In reality, it's a red flag. That yield is high because the price collapsed, a warning sign that the payout might not be sustainable. In other words, if the deal looks too good to be true, it probably is. For long-term dividend income, sustainability is everything. You want companies with stable earnings, predictable cash flow, and a history of rewarding shareholders, not just a single year of flashy payouts. In the US, dividend income is taxable, but the rules can be favorable. Qualified dividends are taxed at lower long-term capital gains rates, while ordinary dividends are taxed like regular income. REIT dividends usually fall in the second category, higher tax, but they can still be worth it for their consistency. The real power, though, isn't just in receiving dividends. It's in what you do with them. Reinvest them, and you turn each dollar into another little worker, one that starts earning its own dividends. Over years, this snowball effect can transform a modest investment into a serious income stream. But let's be clear, to get $1,000 a month, you can't just throw in a few $100 and wait. You need a target, a plan, and the discipline to stick with it. And that's exactly what we'll break down next. Here's the math most people avoid, not because it's complicated, but because it forces you to face reality. If you want $1,000 every month in dividends, that's $12,000 a year. The first question is, what yield can you realistically expect? In the U.S. market, a balanced portfolio of dividend-paying stocks, REITs, and income-focused ETFs might average 4% to 6% in annual yield. Sure, you can find individual REITs or niche stocks paying 8%, 10%, even more, but those often come with higher risk and less stability. So let's use a conservative but realistic example. At 4% yield, you'd need about $300,000 invested to generate $12,000 a year. At 5% yield, you'd need around $240,000 invested. At 6% yield, you'd need roughly $200,000 invested. Yes, that's a big number. And for many people starting from scratch, it feels impossible. But here's the good news. You don't have to hit that number overnight. When you start investing consistently, you have two allies working for you: time and reinvestment. Let's say you start with nothing and invest $1,000 a month into a portfolio averaging a 6% total return, part from dividends, part from growth. In 10 years, you could be sitting on around $160,000 to $170,000, generating close to $8,000 to $10,000 a year in passive income. Stretch that to 15 years, and you're much closer to the $1,000 a month mark, without ever needing to invest more than that $1,000 each month. And here's the twist. If you can increase your contributions early, even for just a few years, you massively shorten the timeline, because those early dollars have the longest to compound. It's like planting trees in your dividend orchard. The sooner they're in the ground, the sooner they start bearing fruit. But this also means one thing. If you want that $1,000 a month in the future, you can't wait until things are better to start. The cost of delay is measured in years of lost compounding, and the clock is already ticking. The first rule of building a lasting dividend portfolio is simple. Protect the principal. It doesn't matter how high the yield looks if the underlying investment is unstable. A collapsing stock price can wipe out years of dividend income in weeks. So instead of chasing the highest payouts, focus on the most reliable ones. Here's what that means in practice. 1. Mix stability with growth. Core holdings. Blue chip companies with decades of uninterrupted dividends. Think Johnson & Johnson, Coca-Cola, Procter & Gamble, or 3AM. These are the foundation. Income boosters. REITs that own high-demand properties, like industrial warehouses, data centers, or healthcare facilities. They often pay higher yields but can be more volatile. Growth plus yield hybrids, dividend growth stocks that may start with modest payouts but increase them consistently over time. Companies like Microsoft or Lowe's. 2. Spread your bets. Diversify across sectors and asset types. If you only hold bank stocks and a financial crisis hits, your income could take a massive hit. Mix in utilities, consumer staples, healthcare, industrials, and real estate to keep your cash flow stable. 3. Check the payout ratio. This is the percentage of profits a company returns to shareholders as dividends. If it's over 80% in a normal year, that's a warning sign. The company might be stretching to maintain its payout, leaving little room for growth or a safety cushion. 4. Look for dividend growth streaks. Some companies, known as dividend aristocrats, have raised their dividends for 25+ years straight. They've done it through recessions, market crashes, and inflation spikes. That's the kind of resilience you want. 5. Be mindful of taxes. In the U.S., qualified dividends from most stocks are taxed at lower rates, but REITs and certain funds distribute ordinary dividends taxed as regular income. Holding these in tax-advantaged accounts like IRAs can save you thousands over time. The point is not to build a flashy portfolio that looks great in a bull market. It's to build a resilient machine that keeps sending you checks, no matter what's happening in the headlines. Because the goal isn't just $1,000 a month next year. it's $1,000 a month for the rest of your life. And the only way to make that happen is to own assets that can weather storms and keep paying you while they grow. But even the best portfolio needs time to work. And that means the sooner you start, the sooner the income starts flowing. Next, let's talk about the timeline and how to get there faster without taking dangerous shortcuts. When people first hear they need $200,000, $250,000, or even $300,000 invested to make $1,000 a month in dividends, many shut down immediately. But that's because they're only looking at the end goal, not the process that gets you there. Here's the truth. Building passive income is less about one giant leap and more about stacking small, consistent wins over time. Let's break it down. If you start with $0 and invest $1,000 every month into a portfolio that earns a 6% average annual return, here's what it looks like. 5 years. $70,000 saved, producing $3,500 per year in dividends, $290 per month. 10 years, approximately $160,000 saved, producing $8,000 to $9,000 per year in dividends, $700 per month. 15 years, approximately $300,000 saved, producing $15,000 to $18,000 per year in dividends, $1,250 to $1,500 per month. It's not instant, but it's steady, and the curve gets steeper the longer you stay in the game, because your dividends themselves start generating dividends. Now, here's how to speed it up without gambling. 1. Front load your contributions. If you can put in extra in the first 3 to 5 years, those dollars have the most time to grow. An extra $5,000 in year 1 could be worth $15,000 or more by year 15. 2. Reinvest everything in the beginning. It's tempting to spend the income once it starts showing up, but early on, reinvest every penny. This is when your snowball is smallest and needs every bit of help to grow. 3. Boost your savings rate with temporary sacrifices. Cutting $200 to $300 in monthly waste and redirecting it to investments can shave years off your timeline. 4. Use raises and bonuses strategically. Instead of upgrading your lifestyle every time your income goes up, keep your expenses stable and invest the difference. 5. Avoid high-fee products. A 1% annual fee might not sound like much, but over 20 years it can eat up tens of thousands of dollars, money that could have been generating income for you. Here's the key mindset shift. You're not just saving money, you're buying freedom, piece by piece, share by share. The day your passive income covers even one bill, you'll realize something important. You're starting to separate your time from your income, and from there, it only grows. But to keep that income reliable for decades, you need to avoid the biggest mistake dividend investors make, chasing yield at any cost. That's where we're heading next. When you first discover dividends, it's hard not to get excited about high yields. You see a stock or R8 offering 10%, 12%, even 15%, and your mind starts racing. At 12%, I'd only need $100,000 invested to get my $1,000 a month. That's way faster. But here's the harsh reality. High yield often means high risk. Sometimes the yield is high because the company's profits are genuinely strong. But more often it's because the stock price has crashed, usually for a reason. Imagine a stock trading at $40 that pays $4 in annual dividends, a 10% yield. If that stock drops to $20 but keeps paying $4, the yield now looks like 20%. On paper, it's incredible. In reality, it's a flashing red warning sign. That drop might mean the company is in trouble, losing market share, facing new competition, or drowning in debt. And if their profits keep falling, that amazing dividend won't last. This is where beginners get burned. They build a portfolio of only the highest yielding investments. And then watch as one by one those payouts get cut. The income stream they thought was permanent dries up. So how do you avoid this trap? 1. Look beyond the yield. Check the company's earnings, debt levels, and cash flow. If a company is paying out more than it earns, that's a ticking time bomb. 2. Understand the business model. Some industries, like utilities or telecom, can support high, steady payouts because their cash flow is stable. Others, like retail or energy, are more cyclical and risky. 3. Watch for payout ratio extremes. If a company's payout ratio is consistently above 80%, it has little room to reinvest or handle downturns. 4. Mix high yield with dividend growth. A portfolio that combines steady, moderate yield companies with a few carefully chosen higher yield plays can balance income and safety. Remember, the goal isn't just to hit $1,000 a month as quickly as possible. It's to hit it and keep it without watching your portfolio crumble. Because once your income starts to feel permanent, the last thing you want is to go backward. And that's why the smartest dividend investors think about something more important than yield alone: total return. That's exactly what we'll break down next. If you only focus on yield, you're looking at one slice of the pie and ignoring the rest of the meal. Total return is the combination of two things: the income you receive from dividends, the growth in the value of your investments over time. Here's why this matters. Let's say you invest $200,000 into two different portfolios. Portfolio A pays a 10% yield, but the share prices slowly decline because the companies aren't reinvesting enough to grow. After 10 years, your income is the same, but your $200,000 is now worth $150,000. Portfolio B pays a 4% yield, but the companies also grow in value. After 10 years, your $200,000 is worth $300,000, and your annual dividend income has grown to $12,000 thanks to consistent payout increases. Which is better? Portfolio B. Every single time. Because dividends aren't just about today's income, they're about future income. When you reinvest dividends from companies that grow over time, something magical happens. Your income stream accelerates without you adding more money. Think of it like planting an orchard. A high-yield portfolio with no growth is like planting old trees that already produce fruit but will slowly die off. A lower-yield portfolio with strong growth is like planting young, healthy trees that produce more and more fruit each year. And here's the mindset shift. You don't need the highest yield to hit $1,000 a month. You need reliable income plus growth so that in 5, 10, 20 years, your $1,000 turns into $1,500, then $2,000, without lifting a finger. That's how you turn dividends from a side income into a genuine wealth-building machine. Now, all of this sounds great in theory, but the real secret isn't in the math. It's in the mindset that keeps you investing year after year, even when it feels slow. That's where we'll finish. The hardest part of building passive income isn't choosing the right stocks. It's staying consistent when the results feel invisible. Because in the early years, your portfolio will feel small. Your monthly income might be $20, $50, maybe $100. And it's easy to think, what's the point? But this is where most people quit, right before the snowball starts to roll on its own. Dividend investing is like planting seeds. The first few seasons, you might only see a few sprouts, but if you keep planting, keep watering, and keep reinvesting, one day you'll look up and realize you've grown an entire forest. That's the moment when your money starts working harder than you do. When $1,000 a month shows up without you lifting a finger. When losing a job becomes an inconvenience, not a crisis. And from there, the question changes. It's no longer, can I reach $1,000 a month? It becomes, how far can this go? Maybe it's $2,000 a month. Maybe it's $5,000. Maybe it's enough to replace your paycheck entirely. The number is up to you. The process is the same. Start now. Stay consistent. Protect your capital. Reinvest your income. Because every dollar you invest today is a tiny employee that never sleeps, never calls in sick, and never clocks out. And the sooner you hire them, the sooner they start building your freedom. If this video helped you see the path to real passive income, like and subscribe for more stories that reveal how money really works and how to make it work for you. And tell us in the comments, what would you do with an extra $1,000 every month for the rest of your life? And if you want to learn even more, we've got 2 videos right here for you. Click and watch. They could be the next step in your journey to financial freedom.